Real estate investment trusts, REITs, is a very popular topic among investors, but today we will approach it from a retirement planning point of view and how you should allocate accordingly. Therefore, we'll talk about having a core portfolio and a satellite portfolio. How to define them? What are the different metrics and financial ratios to look at? And what type of REIT strategy to use for each portfolio? We discuss frameworks for evaluating REITs, and that includes fundamental and technical analysis and an understanding of the macroeconomic environment. We look at upcoming trends and new opportunities. For example, what REITs should you focus on for a COVID-19 recovery play? We also touch on global REITs, including China REITs, so join me in understanding the latest developments. Hello, my name is Andrew and welcome to another Chill with TFC session. In this series, we hope to bring on interesting and relevant people to help us learn better from various perspectives. Life is not always about learning from the people you agree with. Different perspectives shape us to be more well-rounded in our thinking. So in the pursuit of the life we love, while managing our finances well, my guest today is a REIT speaker and trainer at SGX, Singapore Exchange Limited. He doesn't just train, he walks the talk as well. He's a REIT specialist and independent financial advisor. Let's hear from Kenny Loh. So today we're going to talk about REITs, mainly focus on REITs, but because you also have background in retirement planning. So let's talk about REITs in the context of retirement planning. Using the lens of retirement planning, how should you allocate? Do you give a suggestion to your clients, like what percentage of their portfolio should they allocate towards REITs?
Yeah.
Let's tell us about it.
So actually retirement planning, some people make it very complex, but I just want to make it very, very simple. You just imagine yourself, right? If you want to retire at 65 years old, fast forward, retire at 65 years old, you are no longer working in any corporate. You are not exchanging your time for your income. Definitely, you need some sort of passive income to really sustain your lifestyle. For example, you live from 65 years old to 90 years old. There's another 25 years to go, right? So where are the money come from? You always have to think of it. Where the money come from? It's definitely not come from your employment income. Your money can be a few forms. The first of it, you'll be from a cash. Whatever cash you accumulate over the years, basically you'll be drawing down. The second form of income, you'll be from your CPF life. It depends on what kind of CPF life you opt in when you reach 55 years old. I just use some example. If you can top up your CPF life to maybe ERS, you have $2,002 per month income perpetually, which means that if you outlive your own retirement planning at 90 years old, 100 years old, you can get this $2,200 keep coming in. That's the second form of income, right? The third source of income is basically you'll be drawing down for your own investment portfolio, right? For example, you have 1 million investment portfolio. This 1 million you'll be drawing down for the next 25 years. Another sort of income you'll be from your rental income from a property. Okay, the fifth one, probably you can build a dividend portfolio. This dividend portfolio can be consist of bonds and also can be consist of the REITs itself. But each of the asset class, there are pros and cons. So if you look at cash, if you look at the CPF line, they are not inflation hedged. When the CPF life itself, the 2,200 per month is perpetual. That means when you reach 90 years old, 100 years old, they still pay you $2,200. That actually has some disadvantage because over the years you have inflation, right? That means your purchasing power will be reducing. So although you are getting a guaranteed payout, but you'll be losing out over the long term in the erosion of the purchasing power. So you definitely need another allocation into the portfolio, which is inflation hedge. If the inflation goes up, your dividend payout goes up. And also your net asset value goes up, your share price goes up, right? That is the hedge of inflation. So to make it simple, for retiree itself, for retirement, definitely you need two portions. One is guaranteed portion, one is non-guaranteed portion. That will probably build your retirement portfolio nicely. When I talk about retirement here, not necessarily for those younger listener, you need to wait until 65 years old before you can retire.
You got a plan before that.
Yeah, when we talk about retirement, we are always mentioning is financially retired. Okay, you can be financially retired at 35 years old, 40 years old, 65 years old. When you financially retire, you always ask yourself, you are spending this amount of money. Okay, from where, what kind of portfolio which can generate that kind of passive income to cover your expense. Once you are able to cover your minimum expense, you are financially free. You can do whatever thing you want.
So You talk about the guaranteed portion and non-guaranteed portion. How does REITs play a part?
Okay, REITs you play a part in the non-guaranteed portion. The dividend from REIT is not fixed. It can be going up and also can be coming down. So as long as you choose a REIT which have a good track record and have a consistent distribution per unit growth year over year, and also have having a very good underlying property, those are the REIT that you can have a less worry about it. And over the long terms, in the inflation, the rental income definitely will go up. When the rental income goes up, that means your DPU, distribution per unit, you goes up as well. That means your dividend will be going up. Okay, and at the same time, you also can pass on your REIT portfolio to the next generation. It's unlike the CPF life. Once you use it up, your next generation, your beneficiary, will not enjoy anything. Your cash, if you finish drawing down all your cash, you cannot pass on the next generation. So REIT, besides to give you the element of growth, and at the same time, they also can give you a peace of mind for estate planning purpose.
So there's growth, there's the dividend, right? From the REITs itself as well. Okay, so do you have a recommendation for your clients? And the answer is usually it depends. Allocation in terms of like portfolio, how much percentage should they put to REITs as part of estate planning?
Yeah, depends. Okay, first element, we always use a CPF line as a base case for planning purpose. I just quote an example. If you need $4,000 per month to spend, and your CPF life, you give it $2,200, right? That means what you need to figure out is where the 1,800 come from. And this 108,000 come from, it can be drawing down, or you can be fully deploy all your cash to build a dividend portfolio to really cover this 1,800. So from there, you can decide what is the allocation to your REIT and also what are the allocation to your CPF line. Because not many people, they are able to top up their CPF line to the ERS, Enhanced Retirement Sum, to get the $2,200, right? Some of them, maybe they just have enough money to go for the full retirement sum, FRS. So it's very depends. But all these things is better to talk to your financial planner to really work it out, because it's very, very important. You don't go and figure yourself what is the asset allocation.
Actually, this is one of those rare times in our podcast, because we usually have to say that this is not financial advice, because I am not a certified financial advisor, so I cannot give financial advice. But actually, you can.
Yeah, I can.
Kenny can give advice because you're actually certified. But I will still have to say you have to do your own due diligence, do your own homework, talk to your financial advisor, and it really depends on your situation. Like you mentioned, like for example, what is the standard of living that you want? Is it you want 4,000 a month, 3,000 a month? It all plays a part. And therefore you will recommend accordingly.
Right.
But do you have a specific sectors? I mean, there are so many different kinds of REITs, right? For retirement planning, do you have like certain sectors of REITs that you look at?
So when we have not moved into retirement age one, we can take a little bit more risk. Okay, because REIT, there are two elements we can play. The first element is always focus on dividend. Right, when it comes to focus on dividend, we always look at those REIT with a very big market capitalization and also with a very strong sponsor, because relatively those are the safer REIT. But when you save, your return will be drop, you'll be low. So those big cap REIT in Singapore typically give you between 4 to 5%. It's still pretty decent if you look at it. It's better than park your money in the bank.
It's kind of in line with CPF.
Right, in line with CPF, 4 to 5% is pretty safe also, right? Because you are talking about investing in the Singapore shopping mall, in the Singapore real estate, right? Unless the Singapore is invaded by other country, then the enemy bomb all our shopping mall, then our REIT will be estate. So basically it's pretty safe to allocate in those I so-call it's more on defensive, that kind of REIT, right? Another element will be more on the capital appreciation, right? But when we move in the retirement, if you do not have time to really monitor the market, it's not advisable to really look at those REIT with huge so-called growth moving forward. But if you are have not retired yet, but you want to take some high risk, that kind of REIT investing, you can look for the hospitality REIT, right? Because hospitality at the present moment is really beaten down. The price is trading below their net asset value. That means, in other words, it's undervalued. So if you recover from the COVID-19, when you go for the full economic recovery, definitely all these REIT will be catching up. Because you just imagine, now all of us have to stay at home, we are not able to travel. And we are quite sick of staying at home. If one day government open up for us to travel, I think all of us, you go out. You just
Chiong.
go out. Chiong.
Right.
Right. We go. That's why when we go out, all this kind of hospitality sector, the hotel sector, you will start to do well. Then when they start to do well, the dividend, you start to come back. When the dividend start to come back, your share price will go up. So sometimes it's really a no-brainer that what are the sector you'll be doing well, what are sector can make you money in the REIT space moving forward. We can see that. But of course, during this period, we need to make sure whatever hospitality REIT we are holding, they are able to can last through this period, because its cash flow is the most important thing. They must have enough cash flow. They must have a strong balance sheet to really tide over this period. If you are able to tide over this period, okay, that is a double confirmation. Those are very strong REIT. During the bad time, they still can survive. And when we have a full economic recovery, they will be the first one to rally.
Just nobody knows the timeline, right? Because COVID-19, now there's the Delta variant, and it depends on your age as well, and whether you have a longer runway to let it recover.
Yeah,
so there's so many things to consider. And
That's
now
right.
work from home, the office space is also, like, we don't know whether people will be needing an office anymore. So how do you factor all this?
Time horizon is very important, right? If we really 100% rely on a dividend payout for retirement, then I would advise you don't touch those higher risk one, right? Because you do not know what's going to happen. In Singapore itself, although REIT is safe, but in Singapore, there is one REIT actually went bankrupt. Okay, this is a history. This is the first time in our REIT history. So REIT will go bankrupt if their cash flow is not able to really cover all the debt or obligation. So these are the things you have to really pay attention to, right? But if you are able to wait, you have a longer time horizon. For example, you are still young, 35 years old, 40 years old, you have another 10 more years, 20 years to go. By all means, you can allocate some of the maybe 20% or 30% of portfolio, right? And to this kind of high growth sector.
Okay, so you mentioned that the safer ones are the big caps, and the relatively risky ones, if you have a longer time horizon, will be, in this case, hospitality. Any other so-called risky but have the potential for higher returns in near future?
Retail is less risky than the hospitality, right? Because retail, for example, if you're looking at our Orchard Road, there are a few REIT over there, right? Like Star Hill Global, SPS REIT, they have some property in the Orchard Road itself. When we open the border, then the tourists will come back. But during this period, all these REIT, they still can survive. So you should not have any big problem.
Well, they say that e-commerce is coming. I don't know about other countries, but I think in Singapore, right, Singaporeans still love to shop. We still can go out. I mean, because of the distance is also nearer. We can go to the shopping malls easily. But maybe in other countries, they say that e-commerce, and then it will affect the retail REITs.
E-commerce will not affect the retail rate in Singapore, right? So don't read into those newspaper too much. Because one thing for you to invest smartly is to just walk around all the mall in Singapore, right? And especially all the suburban mall, it's so packed, right? And Singapore, where can we go? We got no place to go, right? So retail mall will definitely continue to do well in Singapore, and e-commerce will not be affected because we are just too small. Right, we are talking about US. They're using drone to do the home delivery. We can't even have a drone.
You don't have to. You just go out. Your shopping mall is there already. In Singapore, we're very, very lucky. Of course, we're very fortunate.
So in short, e-commerce will not have a big impact on the Singapore mall space itself. And also now, if you look at the mall itself, because of the strong sponsor or no, they know how to be innovative. They know how to change their business model pretty fast. Now the mall in Singapore is not a shopping mall. It's a big food court. Right? Yeah. First floor, second floor, basically you can see all the restaurant there. Then after that, third floor, fourth floor become tuition center. It's the experiential, that kind of mall. Those are the activity we'll gather together, right? It's changing. It's not traditional. You go and buy those clothes, go and buy those gadget toy. I think those are the more you'll be suffer in the e-commerce space.
Okay, so now that we talk about retail, we talk about hospitality, like what kind of REITs are you yourself focused on?
Retail, at the present moment, I'm focusing mainly for my core portfolio. I have two portfolio, and also for a professional investor, we always have a core portfolio and also have a tactical portfolio. We call it satellite portfolio. So typical allocation, you'll be 70% core, 30% satellite, right? Core, basically, you are holding for long term, right? You are selecting all those strong and defensive REIT in this core portfolio. You just focus on getting a dividend. So my core portfolio basically consists of mainly on a suburban retail mall, right? I'm not focusing on those in Orchard Road, right? And also not in the like Vivo City or Plaza Singapore, those things. Those are not in my core because those are very dependent on the tourists. Okay, but I'm playing those waiting for border reopening in my satellite portfolio.
Okay.
Right. So when you play a satellite portfolio, I'm using a technical analysis to help me, and I'm also be prepared to see the big drawdown in terms of the DPU. So I have different criteria for different portfolio.
Okay, so help me understand a bit about the satellite portfolio using this term. So it's something more risky or things that you want to, like you have a certain hypothesis and you want to test it out and therefore you put it in the satellite portfolio.
Satellite mainly is more on tactical play.
Tactical.
Yeah, tactical. Tactical, that means that when I find opportunity to go in, when it hits certain price target in terms of valuation, right, I will get out.
Yeah, okay.
Right. It's a little bit of trading over there to really maximize the return. Right. For example, definitely hospitality sector is not in the core because I don't expect any good dividend coming in. But hospitality at the present moment, the valuation is beaten down. It can be 20%, 30% discount to their book value. And I know pretty clear that because you look at historical price, you know that before the COVID-19, maybe they're trading a book value of 1.2 times, 1.3 times. If at the present moment, the price to book is only 0.7, but pre-COVID is 1.2, you can see that immediately you have 0.5 opportunity, maybe 50% growth opportunity. I just play on that one. But when I looking at a satellite portion, I have to look at different metric, different criteria. I cannot look at dividend as a criteria because if you look at dividend as a criteria, that's a wrong criteria. You're not going to get any dividend anyway. So price to book is a very important criteria. The second thing is their interest coverage ratio. Okay, basically interest coverage ratio represents that how much rental income you generate per month, and their ability to pay off their interest expense. Like the normal property investing, you need to make sure rental income come in is sufficient enough to pay off your mortgage. That is a ratio. The higher the better. So I need to make sure the ICR is high enough for them to tie through the whole period. Right? But if the ICR is too low, means that at any time they can go bankrupt. When they go bankrupt, your whole REIT will be suspended. So it's a little bit risky in that case.
Okay, so the metrics ICR, PB, price to book. What else? What other metrics do you look at?
And also gearing.
Gearing.
Yeah. Gearing is the ability to borrow. If you have very high gearing, that means your ability to borrow is much more lower. And if during that time you want to ask for money, but at the time of time no bank want to loan you money, you are screwed.
So to define gearing is debt.
Debt divided by your total asset value, right? But in Singapore itself, the MS has regulation to have a 50%. Right, that's why if you are closer to a 50% mark, you are not able to really continue to borrow more money. If you are not able to borrow more money, the only way is either you have to sell your own property or you have to issue additional share to raise fund. Once you issue additional shares to raise fund, your share price will drop. Then when the share price drop, immediately you lose money on the capital side.
Okay, so core portfolio, satellite portfolio, what's the main difference between the two?
The main difference between the two is one is more stable in terms of dividend.
Stable, you look at what metrics?
DPU.
DPU, okay.
Right, DPU. That means they are able to generate the DPU in a consistent and also in the long-term growth. You can see from a DPU payout.
Okay.
Yeah, that one mainly you don't touch it, right? Because they are really strong. It's quite boring. It's supposed to be boring, right? If you feel that your reinvesting is just too boring, nothing much to do, you want some excitement, that means you are doing the right thing. Right? Okay. Investment is not always you want to go for excitement. No, that's the wrong thing. Right? When you have too much excitement, that means your portfolio is not doing. You are trading. You are not constructing a portfolio properly. Right? And the satellite portion will be more on a short-term basis. It's more on tactical. If something change in the market condition, you have to either cut loss because they tends to be more volatile. Because one of the benefit of REIT is while waiting for capital appreciation, you still can get a dividend. So you're being paid for waiting. So I use a REIT for my satellite portfolio.
Okay, so satellite portfolio more of like growth opportunity. Your core portfolio DPU is very important. Like your dividends coming in have to be very important.
Right, that's right.
Okay, so that's the main difference in how you allocate accordingly. So, what do you have in each of them? Like, how about your core portfolio? What do you have in your core portfolio right now?
I have some industrial REIT, right? Those big cap and Temasek Link. How worse can it go? Temasek Link, that means that Singapore government own part of it, right? So that will give me the stability, give me quite a decent dividend, right? And also long term wise, they are able to grow, and also have some US commercial REIT office REIT in my portfolio, because surprisingly, everybody talk about work from home, right? And the REIT will be affected, the occupancy will be affected. But if you really look at all those financial ratio and look at all the earnings, US office is not really affected.
People are still going to the office. Is that what you're saying?
The occupancy rate is still pretty high,
Okay.
and also the lease expiry is still pretty long, right? That means that over the long term, maybe a few years time, the DBO will not be affected. That means I can see some predictability and also sustainability of the dividend coming in from a core portfolio, right? And beside that, in my core portfolio, as what I said just now, I have a suburban mall, right? Suburban mall able to give me about 4 to 5%. Why not, right?
Okay.
It's still better. Then the satellite portion will be more on the tactical, like hospitality sector, and also I have some retail mall, luxury mall portion, because I'm betting on the border reopening.
Okay.
Right? Border reopening, tourists coming in, the spending and the retail sales goes up, then that will boost up the DPU. When the DPU goes up, your share price will goes up. Okay, once I hit that level, maybe I will just restructure again. I take profit and I'll switch to somewhere.
Okay, so core portfolio, you have your suburban malls, you have your industrial, and you have your office space. And then satellite, you have hospitality and the luxury malls. Did I miss out anything? How about data centers?
Data center, I start to accumulate because of the recent correction in the big cap space. Data center is, for me, is in the core portfolio, because I have a strong conviction on the long-term growth of the data center.
Okay, so let's talk about analyzing all these different REITs, right? You have fundamentals, you have the technical. Like, how do you approach them in terms of analyzing the REITs?
Okay, basically I'm using FATAMA, fundamental analysis, technical analysis, and also macro analysis, because macro is still very important, right? Once you know how the macro can affect the REIT itself, then I will know that what kind of FA data, fundamental, basically look at financial ratio, which financial ratio makes sense. It cannot just apply across the board blindly the financial ratio, right? Today you have very high gearing or have very high yield does not mean that you are okay or you're not okay. It depends on the situation. So I always start from the fundamental analysis first, because first thing first, I have to identify what the REITs are good fundamentally to put into my watch list. That is the most important thing, because after analysis, you are not going to buy tomorrow. You have to watch and have to wait for the right timing. So fundamental analysis, I am looking at the basic three key financial ratio, distribution yield, but just take note, distribution yield, they are lagging. It's a past data, right? You just take that one as a reference. Gearing, they are also lagging. PNAV, price divided by NAV, they are also lagging. So I look at these three initial metrics to do the screening. It's helped me to do screening only. Then I will move into looking at the qualitative analysis, right? Because the financial ratio, they are quantitative. Qualitative, I will look at the how diversified are the portfolio, who are the sponsor, where are the location, what are the investment mandate, those things to make some judgment call, right? Then the third one, you become to the risk assessment. Risk assessment, typically I will look at the weighted average lease expiry, whether it's long or short, and depends on the economic environment. For example, under the poor economic environment or during a recession, you want your lease profile as long as possible, so that you will not be impacted by the tenant after they expire the lease. They are not going to continue. But during the economic booming session, you want the lease to be as short as possible, so that you are able to capitalize the increasing rental in the market itself. So there is no one fixed formula on whether it should be long or should be short. So investor, if they don't know what they are investing, they will be analyzing the wrong thing. So risk expiry is one of the risk assessment area that I'm looking at. The other area I am looking at is the weighted average debt maturity. And a lot of wrong perception in the investor itself. When the interest rate goes up, share price will come down, because they jump into conclusion when interest rate goes up, that means the cost of debt you going up, the DPU will be you drop. Right?
Well, that's what the textbook says, but actually the economy hasn't been following the textbook for the past few years.
It's not true at all. Because if you look at the debt maturity profile, some of the REIT, that debt only expire in 3 to 4 years later. That means that they have already locked in the fixed interest rate for 3 to 4 years later. So whatever changes in the current interest rate, basically no impact on the REIT itself. So we have to look at the debt maturity profile to really identify whether there's any reaction to the DPO payout. For example, during the low interest environment, we want the debt maturity profile as short as possible, so that when you refinance at a lower cost, right? If the interest rate is going up now, what the REIT can do is they can bring forward to redeem all your debt maybe in the next 1 or 2 years time, right? Then refinance as a lower interest to really capture the opportunity. So it's very much depends on what the REIT manager is going to do. So the quality of the management decision is very, very important. Right? Those are the qualitative and also risk assessment perspective.
So to put it all together, you use fundamental analysis to identify which REITs to put on your watch list, and then you use technical analysis to determine which price point to enter the market. That's for timing, right?
That's the timing.
And then behind all of it is the MA, your macro analysis, understanding which part of the economy are we at. I mean, right now we're not fully recovered, that's for sure, but we're not at the bottom of the economy as well, right? It's like we're sort of slowly recovering, but there's always uncertainty about whether COVID or like new variants will affect this recovery. So we have to understand the economy as well.
One very important thing to take note that in the investment world, there's something called is a mega trend. There's something called a noise, right? Noise, you'll be subjected to all this kind of economic news, economic data, and also COVID are the noises. But you cannot beat the mega trend. The mega trend, as long as you run on a mega trend, you manage your portfolio volatility, you are good with it. So what is the current mega trend? The current mega trend is we are under the low interest environment. We are not going to see the interest rate goes up to very high level in the next 2 years, because US Federal Reserve, you talk about they want to raise the interest rate in 2023. At the present moment, I don't think they will increase the interest rate, because at the present moment, we are still not getting out of COVID yet. It's still pretty fragile, pretty weak in the economy. So under the low interest environment, this is a very good support to the whole real estate sector. Because you just imagine if you're a property investor, if you're getting the bank loan, okay, I just did a research on, I think the mortgage loan in Singapore is about 1%. It's surprisingly low. You just imagine you borrow money 1% and you invest in the property, maybe give you 3 to 4%, you immediately can get arbitrage. This is how the investor make money, using the interest arbitrage concept. So definitely under the low interest rate environment, that will encourage a lot of acquisition. At the same time, you also encourage people to borrow more money for aggressive buying all the REIT for the future growth. Okay. Right? But on the other hand itself, under cheap money and also frequent liquidity, right, that will inflate all the asset price. Right? Now, last year, why all the net asset value of the REIT being beaten down? If you look at the valuation model for all the property, the analysts always use either the discounted cash flow model, right? Basically, you can see all the rental income for the next 10 years, right? Last year, whenever the analysts put some rental forecast, they are not going to put very high number. Nobody dare to put very high number because there's no visibility, right? You just imagine, we are coming out from the COVID-19. Most likely, they will start to be more aggressive in the rental forecast, right? They'll adjust the growth rate, it will be even higher. When the growth rate becomes higher, your valuation of property value goes up, right? That is one of the valuation model using discounted cash flow. The other model, you'll be using a comparative method, right? If you look at all the surrounding property, what is the what is price per square foot PSF that they are selling, right? If the whole property market is on the increasing trend, the price PSF will increase. That means you increase all the valuation. So moving forward, your NAV goes up, and your price you have to catch up. The stock price have to catch up to maintain that kind of ratio.
Okay, so let's look at trends. Let's look at S-REIT. So tell us about the fluctuations in the S-REIT index this year.
So actually, S-REIT has been moving sideways for the past 1 year. It's really going nowhere. They are, the REIT index itself, they are trading within a range of 775 to 890, right? It's pretty wide range. At the present moment, on the last Friday close, they are testing the resistance of 890 for past 1 or 2 weeks.
For reference, today we're recording on National Day, 9th of
National Day.
August. Okay.
So I think at the present moment, the REIT index is 882 last Friday, and we have an announcement come up. We are getting up from phase 2.
We're definitely opening up the economy.
We are opening up tomorrow. Tomorrow. So I'm watching tomorrow to see whether there is any positive reaction on the REIT index itself. If the REIT index can be convincingly break this resistance and also trade above 900 points, that will kickstart the new bull run for the whole REIT index Singapore.
Well, I think what's interesting is that you can go on a time travel with us because we're recording this, but it won't be posted immediately. And so when you're listening to this podcast, the listener, like you can track back to what Kenny is saying. So you're looking at the data to see if that it will kickstart the next bull run.
Yeah.
Opening up means we can go out and eat, we can gather in bigger groups.
Yeah, the news just comes out a few days ago. So at the present moment, it's also at a resistance. So if the investor or the institutional fund, they have a higher confidence, Singapore is really moving into the full economic recovery, they'll move their money into a Singapore REIT market, right? Because I have done a study on the US REIT index and also US REIT ETF. They have been on the uptrend for many months, but Singapore still moving sideways.
And if we are treating COVID-19 as endemic, then by right, we shouldn't be going back to a lockdown situation. But then we just don't know. We just don't know what's going to happen.
Unlikely. I don't think so, because we have already gone through the worst, and I don't think we'll go back to 100% lockdown. No way. Because during that time, a lot of things still uncertain. We don't have a testing kit. Now we know this COVID-19 much more than other people, right? We know how to contain them. We know how to detect them. We know how to prevent them. We know how to cure them. So we are much more better now. So I also understand there are a lot of investors out there still worry about, are we going to have another crash? But personally, I don't think so. The current situation are totally different.
Okay, so to summarize, the S-REITs, they are moving sideways so far this year, but you're looking forward to when the economy opens up, that there will be a bull run in terms of the prices of the Singapore REITs. But that's looking at Singapore's situation. But so many local REITs are buying overseas property as well. So how does that affect the whole valuation of the REITs?
The reason why the Singapore REIT has to go overseas is because Singapore is still too small. We are in the land scarce environment. A lot of good property already be REITed. So we got nothing good one left to be acquired. But the REIT manager, they have the investment mandate. They have to grow the portfolio, grow their AUM, asset under management, and also grow their DPU year over year. They have to do that because that's the KPI. So if they are not able to find any good one or yield accretive acquisition in Singapore itself, they have to go overseas, right? Because at the present moment, because of the strength of the Sing dollar itself, they are able to really buy overseas at a cheaper rate, and at the same time, they have a much higher yield than compared to Singapore. But this also exposed to another such risk, such as the forex risk, regulation risk, and also the local economic risk, and also government risk. So all these risks has to be compensated. So in order for those REIT who want to go overseas, they need to give investor higher DPU in order for the investor to invest in them.
Can you maybe share with us a general idea, right, how much exposure they have to all this foreign property? Because like you're saying, we're looking at Singapore situation, but if they have like invested in overseas property, then maybe the situation in Singapore will affect it only to a certain extent. Right? It also depends on what's happening overseas. And the thing about COVID is that no country is safe until all countries are safe.
Yeah. So there are certain correlation when you look at the DPOU itself, right? For example, if you're looking at the Fraser Center Point, which have 100% shopping mall in Singapore, the yield trading between 4 to 5%, right? And if you're looking at the one of a grocery and also retail in US, that one is United Hampshire REIT, that will give you about 7%. Can you see the spread? Right, there were 2 to 3% spread. And if you compare the industrial sector, for example, Mapletree Industrial Trust, Mapletree Logistic Trust, and also Ascenders REIT, they are trading also between 4 to 5%. But if you compare to the European REIT, for example, Cromwell European REIT, the yield is about 7 to 8%. And IREIT Global, they also have the office in Europe, especially in Germany and also Spain. The yield about 7%.
Yeah, the growth is still in overseas. I mean, there's limitations in Singapore market.
Yeah.
We all know that.
The growth in overseas definitely is overseas. And if you compare to the office rate, Singapore office rate, you have Suntec, you have a Keppel REIT, the yield about 3 to 4%. It's pretty low. But if you compare to the US office rate, 7, 8, 9, that's the spread.
Okay.
So if you want to have some excitement, right, but you have some higher yield, there are some of the good REIT out there having the overseas property, I think is good to look at.
Okay.
Because I don't think the currency fluctuation can wipe out 3 or 4% the yield spread.
So let's take a look at some international REITs. What international REITs are you looking at? Does it include China REITs and also foreign listed REITs in Singapore?
Okay, for China this year, they have already made debut on those China REIT on the Shanghai and also Shenzhen Stock Exchange. And recently, I have received a lot of inquiry from some of the China investors ask me how to do the valuation on the China REIT itself. They don't know how to do a
Yeah,
valuation.
where is the data coming from?
Yeah. It's pretty new to them. And basically, okay, in short, China REIT is different from Singapore at the present moment. Because Singapore, we are talking about acquiring the industrial building, acquiring a factory, office, shopping mall. But China REIT at the present moment, they are just focused on infrastructure, right? And infrastructure, there are a lot of government-linked business. They just want to have a private investor to really pump the money into infrastructure. So at the present moment, I don't have data on this China infrastructure. Personally, I don't feel comfortable at the present moment for China REIT. Okay, because the infrastructure is totally another area that may not be so transparent.
Do you have a source for the financial reports?
No,
right?
not yet.
I mean, unlike Singapore and of course US listed REITs, yeah.
The next thing I will look at it because I also want to master a China REIT. That will be my next homework, my next ambition.
Your satellite portfolio,
satellite.
the exciting part.
Yeah, exciting part.
Yeah.
But because of the China REIT introduction in China, that will indirectly to create a lot of China investor. They want to invest in REIT. The reason being is because REIT is a very good concept, right? But they are not comfortable with the China REIT because they are still very new. They prefer to look at some other country REIT, for example, Singapore or US, which is more mature and more transparent and easy to do the valuation, right? And although China is at the present moment focusing on infrastructure, but I think very soon they'll open up for China REIT to acquire on those business park in China, hotel, shopping mall in China. It's a next step. Definitely will be a next step if you look at the trend. And at the present moment, the US REIT market is the largest. It's about 1 trillion market capitalization. Singapore is only 100 billion. China is considered zero. They are just at the infant stage. You just imagine, if US is the economic superpower, China, they always want to play like catch up. So I can see that China REIT itself, they have a huge growth moving forward. They will definitely catch up to US. And one good thing about some of the REIT listed in Singapore, for example, CapitaLand China Trust, this year they just expanded a mandate to invest in the business park in China, data center, hotel, and also some of the commercial office. Those are the way I look at it. I I really applaud the management for making this a decisive decision to expand the mandate to capture the market opportunity, because this is the first mover advantage. Even the China REIT itself, they are not able to acquire all this property, but CapitaLand go in there, change it from the pure retail play to a multi-asset, that kind of play.
They also have their own satellite portfolio. They have their core and then
Yeah.
new growth opportunities.
Yeah, new growth opportunity. And so far, none of the REIT in Singapore have a data center in China. You just imagine China is already moving towards the e-commerce. They are so advanced, but we don't have anything in a data center in China. But CapitaLand itself, they have already acquired data center. Who knows, maybe in future or near future, they'll pump this data center into CLCT.
Okay. So China REITs right now, you're saying there's infrastructure, and then later on you will have business parks, you will have data centers. Well, and soon enough, I think there will be the retail REITs as well, because China wants to raise the standard of living, right? Increase domestic consumption, and so you'll see how it plays out in China. So you're doing your homework. Have you dabbled in? Have you tried something on your own, or it's just like researching?
Researching at the present moment, I dare not touch the infrastructure. Right, at the present moment.
Just learning, and when there's the right opportunity, if the timing is right, then you will maybe get in as part of a satellite.
Normally, I will wait for 2 or 3 years to monitor the performance, because they have to, in Singapore itself, every quarter they have to release the earnings or give some business update. I'm not sure about China, how frequent they give this kind of business update. So through all those earning release, through the management decision, you roughly know that how they make the decision, whether they are able to deliver what they have committed. That's the most important thing. If they are able to do that consecutively for the next few years, you know that more or less these are the stable one. These are the reputable one.
Oh, do you know how do we buy China REITs though, right now?
I have no idea.
Exactly. I'm like, okay, like if I want to buy, let's say I want to take risk, and how do I buy?
You should be able to buy somewhere. I don't know, right? But
Okay.
I know, but I did do a research on the Hong Kong REIT and also the Australia REIT. But after I spent some time on the Hong Kong one and also Australia one, at the end of the day, I still pull my focus back to focus on Singapore. Because nothing exciting. The most exciting is all in Singapore.
What do you mean by most exciting on?
Because at the end of the day, the first thing first, when you invest in REIT itself, we're looking for dividend. So, for example, Hong Kong, there's one Link REIT, is the Asia Pac largest retail REIT. The dividend is about 3%, and also traded in Hong Kong currency. There's a forex risk, right? 3%, I can find something good one backed by Temasek in Singapore. So I don't really need to go up to Hong Kong to look for all those REIT, right? On the Australia one, they have some of the very diversified kind of REIT. You give you about 5-6%. I also can find in Singapore. It's nothing.
How about foreign listed REITs in Singapore? Do you look at them?
Listed REIT, just now I mentioned that Elite Commercial REIT, they are holding some of the commercial office in UK, and their tenant are UK government. So they just IPO, I think 1 or 2 years ago. So far, the performance has been good, and also the dividend is as per the IPO, committed in the IPO. No surprise. The only concern for me is because they are newly IPO, and also if you look at how the sponsors start to form together. I think they have 3 sponsors. They form a group together to acquire the property. Then after that, they read it. So I have a little bit of concern on the sponsor itself, because typically there are 2 types of sponsor. One type of sponsor, you'll be the developer turn sponsor. Developer turn sponsor like CapitaLand, like CDL, Mapletree, they have a pipeline or a property to be injected for the capital recycling. So they have a clear strategy. The other type of sponsor is a financial sponsor. You know, the financial sponsor, when they group together, they just want to make money, right? So they may not really concern about the long-term growth. It's none of their business long-term. So I'm a little bit wary of those financial sponsors. I need to wait to see how's the performance before I make a next decision, right? And the other one will be a Cromwell. So far is doing good in Europe. They are expanding the portfolio. They are changing and also restructuring the portfolio to be more logistics-centric. Because moving forward, if you're talking about all the e-commerce logistic sector, you'll be the main economic pillar to supporting that kind of growth. And some of the other REIT, for example, BHG Retail Mall, that one is focusing on the China retail mall. So far, it's a pretty small REIT and also not so liquid. I basically I don't touch.
Okay. Thank you, Kenny. Shared a lot with us today. Hey, I hope you learned something useful today, and I truly appreciate that you took time off to better your life with the financial coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description. For more information, check out thefinancialcoconut.com. With that, have a great day ahead, stay tuned next week, and remember, personal finance can be chill, clear, and sustainable for all. I have 3 questions for you. What is your core life principle?
Core life principle.
One core life principle that you hold. You can answer it any way you want. Whatever that comes to your mind.
Trustworthy. Trustworthy and always do the right thing. Right? And because that is also guide me when I advising my client and also leading my team. I always tell them, I know that in our life itself, we have certain criteria, we have certain priority, we have certain KPI to meet, right? And some of the KPI, you know that you do something maybe not ethical or do the thing not properly to meet a KPI. But at the end of the day, this is not sustainable. More important thing, they always believe in themselves doing the right thing, right? Because doing the right thing is the most important thing.
Trustworthiness.
Trustworthiness.
Okay. What is one piece of financial advice that you think should be shared more often?
Everyone should have basic financial literacy. Because if giving a chance for me to go back 20 or 30 years again when I first come out from university, but by the way, financial planning is not taught in the university or in any syllabus. I think that is one of the things that we probably have to educate more people. If I come up from university again, I would love to have a financial advisor as my mentor so that to guide me to do the proper thing. Because if I think back a lot of things, I can retire much more earlier. If I do things properly, because we have limited financial resources when we come out from university. The most important thing is we must know how to optimize our financial resources, doing the right thing, allocate into the right thing, right? One very simple example. Actually, insurance is very, very important, okay? But buying the right type of insurance is as important. You don't go and buy the wrong thing. I only start to realize it. I bought the wrong insurance, okay, when I reached 40 years old. And when you buy insurance at the too late age, the insurance premium is very premium is very expensive. So at the present moment, I'm doing all the right thing for my children. I give them I bought them some plan that can last them throughout the whole life. That will be my best gift to them. Today, they may not thank me, but when my children reach 30 years old, 40 years old, 50 years old, they'll thank me for that. Because they don't need to worry about the insurance premium next time. Because the insurance premium, if you buy when they are still baby, you imagine how cheap is the insurance premium.
So get financial knowledge as soon as you can. It's the piece of advice that you think we should all be hearing more often, right?
Yeah.
Okay, my last question for you today is, what is one area of your life that you are giving additional focus?
At the present moment, because there are some inquiry from China itself to understand about Singapore REITs. So at the present moment, I'm focusing on coming up with a syllabus itself to be able to teach all those China investors or even some of the broker in China how to do the valuation of the Singapore REIT. It's more education, so I can help the China side to really help them to grow the China REIT sector. I'm working at SGX on this syllabus. But by the way, I'm also the trainer for SGX Academy. Right, this is the thing I'm focusing at the present moment.
So we can expect more investments from overseas into our local REITs from China, right?
Definitely, because the more we educate the overseas investor, especially China, we don't need a lot of people. We just need 1% of the investor come to Singapore. Then that will support the whole Singapore REIT sector.
Okay.
It's good for everybody.
Okay, you heard it here first. Thank you, Kenny. Thank
you. Thank you.
All right, thanks.